Hello and welcome to MSI's latest webinar. My name is Simon Mason and I'm the Sales and Marketing Manager at MSI. And today I'm joined by David Jordan, MSI's Regional Director. Today's webinar is a little bit different. It's a shipbuilding webinar where we will be talking about MSI's shipbuilding forecast. We've given it the title, An Optimistic Outlook. The presentation will last for 25 minutes and there'll be an opportunity at the end to ask questions. You can submit your questions by using the Q&A icon to the top right-hand side of the screen, just where you see the question mark symbol. As ever, we always encourage you to ask questions. If you don't get round to asking your question before the end of the presentation, don't worry, you can always email it to us at info@msiltd.com. And now, over to David.
Thanks very much for that, Simon, and welcome everybody. We really appreciate you taking the time out of your day to attend the webinar. Now, as Simon said, I have the pleasure of presenting MSI's latest outlook for the shipbuilding market over the next 20 minutes or so. Now, as I'm sure you're all aware, the shipbuilding market is an incredibly complex global industry, and it's very difficult to do it justice in the time that's available to us. So the aim of today's webinar is really just to give you an overview. Over the course of the webinar, I'll be focusing on three main areas. So first, I'll give you an update on the current status of the shipbuilding market and where we are today. I'll then move on and present MSI's outlook for the market. We'll spend some time looking at our short-term forecasts for the next 12 to 24 months, as well as the longer-term trends all the way out to 2035. And finally, I'll round off proceedings with an update on the status of alternative fuels and their role in shipbuilding. Now, as with other shipping markets, the shipbuilding industry has not escaped the pervasive impact of the COVID-19 pandemic. If you look at new building contract developments from a very high level, you could really arguably split development since the start of 2020 and the onset of the pandemic into two discrete categories. So the first ran through to the end of Q3 last year. And I think it would probably, charitably described as very difficult at best. And the second phase, this was characterized by an uptick in contracting activity in Q4, and that's continued into this year. And with it, it's engendered a really positive atmosphere and rather upbeat sentiment in the shipbuilding industry. Now, this is a very familiar meta-narrative, and, while it is largely correct, I think it is worthwhile in picking some of these trends and pulling out some of the nuances. So in order to do that, we first need to really rewind the clock. And I just want to make the point that it's important to remember that fresh new building contracting had been relatively muted in the years leading up to the pandemic. So obviously we had that nadir that was registered in 2016, but contracting levels did recover after that, but they still remained at relatively modest levels. Between 2017 and 2019, global new building contracting averaged around 54 to 55 million gross tons per annum, and that compares to close to 70 million gross tons per annum in the first half of last decade. Now, this slowdown was driven by a number of factors. The fleet was relatively young. Trade growth in certain key markets was slowing. And as we approached the end of the decade, so 2018, 2019, we started to see this emerging uncertainty over new build technology, fueling choices really start to come to the fore. Now, what the pandemic did was essentially amplify those existing concerns. And, for most of 2020, shipyards were very, very adversely impacted. So if you look at contracting in the first 10 months of last year, it totaled around, I think it was 22 to 23 million gross tons, which on a year-on-year basis is about a 45% decline on the same period in 2019. Now, fortunately for shipyards, there was this late surge in contracting towards the end of the year. The most dramatic upswing was seen in the container ship sector, But the bulker, the gas carrier markets also outperformed our expectations from earlier that year. And overall, we ended 2020 on a relatively positive note with, about 41, 42 million gross tons of new build contracting in full year 2020. Now, despite this last minute recovery, overall contracting levels were still down year on year, I think around about 14, 15%. And that, in conjunction with the relatively prompt delivery of tonnage from yards last year after the initial problems at the outset of the pandemic, meant that what we saw with the order book by the end of 2020 was that it had shrunk. I think it was equivalent to just shy of about 10% of the fleet. So by that metric, it was actually at its lowest levels since the early 1990s. Now, this resurgent interest in contracting has continued into 2021. And according to our most current estimates, we're placing contracting in the first 5 months of this year at around about 35 to 36 million gross tons. And it's quite impressive when you look at that compared to 2020. I mean, the 5-month figure is actually just 15% lower than the full year total for 2020 contracting. However, it is important to recognise that activity and interest hasn't been spread evenly across ship types. So container ships have absolutely led the charge, and they account for almost half of all contracting in the first 5 months of this year. There's also been a substantial uptick in LPG carrier contracting, but levels are very modest in other ship types. For some markets, this is hardly surprising, and here I'm thinking about the tanker markets. They're currently struggling with very challenging freight markets. What's a little bit more surprising is the lack of activity in the bulk carrier market. We are seeing extremely firm earnings in the sector. However, on the whole, owners are actually showing a clear preference for acquiring vessels on the second-hand market rather than placing new building orders at shipyards. Now, as the chart on the left shows, the slowdown that we saw in contracting last year absolutely fed into new building prices. However, what is quite interesting is that the scale of that decline in 2020 in new building prices, it was actually relatively muted. Overall prices held up relatively well in 2020, despite the initial impact of the pandemic on shipbuilding demand. Broadly speaking, we attribute this modest decline to two factors. First is the rationalization of shipbuilding capacity globally. Global shipyard capacity is currently around about 65, 67 million gross tons, which is about 40% below its peak in 2011. The other factor supporting prices last year was shipyard costs, which fell by about 8% between 2018 and mid-2020. Now, obviously, there has been a very, very sharp reversal in price trends this year, and we've seen increases across the board. And as the graph on the screen shows you, I mean, these increases are probably most pronounced, or absolutely most pronounced, in the bulk carrier sector and in the container ship sector. Now, these increases have been driven by a number of factors. We obviously have the very strong new building interest in certain markets. However, that really only partially explains this step change in prices that we've seen in recent months. And a number of other factors have been at play, all of which are really squeezing shipbuilders' costs. First, tying it back to COVID-19, the disruption to the global economy by the pandemic has undermined the US dollar. And what we saw, particularly in the first part of the year, was a dramatic strengthening in the Asian currencies. And although this strengthening has eased in the last month or two, it still remains a factor. The more significant factor is the rapid rise in steel prices. Now, the graph on the left-hand side of the screen is actually the developments in price of iron ore since 2010, and I just wanted to put it there because it's so dramatic and so unprecedented. And what we've seen is that dramatic increase in the price of iron ore over the last year. And obviously this increase has impacted the price of steel. So over the last 12 months, Japanese steel plate prices have increased by almost 50%. Chinese, Korean steel plate prices have increased by around about 2/3 over the same period. And all of these are feeding into these increased new building prices. Moreover, we do expect this state of affairs to continue moving forward. And we expect shipyard costs will remain at relatively high levels through to the middle of this decade. We expect that this will translate into higher new building prices. However, we are also expecting yard forward cover to increase significantly. And that leads quite nicely into our forecast. Because this increase in yard forward cover is going to be driven by, a step change in contracting. Now, according to our most recent modelling, the results of which were actually finalised last week, 2020 is the nadir of the current new build contracting cycle. We do expect levels to spike this year, and as I said, that's largely going to be driven by container ship new build contracting. However, this is somewhat of an outlier, and once the current container ship contracting boom plays out, levels are going to fall next year, but then after that, they're going to start to recover. Now, looking ahead, I think the best way to characterize our contracting forecast as beyond 2021 is really as a modest but a sustained recovery. We're not expecting levels to reach the heights of the contracting spike in 2013. However, by 2025, we do actually expect annual contracting levels to be comparable with those that we saw in 2014, 2015. Moreover, we expect contracting to average around about 70 million gross tons per year between 2022 and 2035. To put that into historical context, between 2010 and 2019, the annual average was actually 60 million gross tons. So as I said, there is that step change. Now, what underpins that outlook? Well, central to MSI's contracting forecast is an assessment of long-term future requirements for new tonnage by ship sector and ship size range. From this, we derive annual contracting volumes over the whole forecast horizon. Now, the primary components of new tonnage demand are, number one, anticipated cargo growth, and number two, fleet development. Let's look at seaborne trade growth first. Now, it shouldn't come as a surprise to anybody on this webinar that the COVID-19 pandemic remains the primary driver of global seaborne trade. Last year, in 2020, we saw overall decline in seaborne trade volumes of around about 4%. And we expect trade levels to recover this year and actually exceed those recorded in 2019, after which point they'll then continue their upward trajectory. But when you're looking at the longer term, there are actually a couple of things worth noting. So first, we do expect growth, but it's much more modest levels than we've seen in the last 20 years. And second, demand growth won't be concentrated in the traditional bulk markets. So it won't be concentrated in, say, crude oil products, or in the second half of this decade onwards, dry bulk. Instead, the sustained growth that we see over this forecast horizon to 2035 is really going to come from, container ships, more niche markets. Now, the second driver, as I said, is replacement demand. Traditionally, replacement demand is largely dictated by the age of the fleet. Now, despite some youthful segments, the average age of the world fleet is still around 20 years, 20 years old. And as the graph on the left-hand side of the screen illustrates, around about 7 to 10% of each ship type is actually currently over 20 years old. That represents a relatively large pool of potential scrapping candidates, and it's only going to increase as we move forward in this decade, and as those vessels that were built in the 2000 super cycle start reaching their that 20th anniversary of their fourth special survey. Now, the chart on the right illustrates our expectations for scrapping through to 2035. In the near term, we expect scrapping levels to be on par with those seen in the post-super boom recession. But after 2026, there's going to be this major step up in scrapping levels. So if you look at the 10-year period between 2026 and 2035, we're actually forecasting annual average scrapping levels in excess of 45 million gross tons per annum. To put that in perspective, the maximum amount of tonnage scrapped in a single year in the last 10 years was in 2012, and that was around about 33 million gross tons. Last year, we only saw just shy of 13 million gross tons sent to the breakers. Now, this outlook is admittedly very, very robust, but it isn't just driven by the age profile, by that traditional factor. Instead, there are a combination of additional factors feeding into it. Namely, we've got market fundamentals, and crucially, we've got tightening environmental regulations and how these are going to impact the economic viability of the vessels in service. And that's what feeds into this very, very robust outlook. However, there are downside risks. Further rate spikes, such as what we're seeing in container ships at the moment, for example, could limit the appetite for scrapping. Also with the requirements for green cycling increasing, a lack of compliant breaking yard capacity could start to act as a constraint on recycling activity. Now, with respect to our future, our forecast, our future view of contracting, there's a few notable trends worth pointing out, and I'll just do this very, very quickly. Unsurprisingly, we do see China as an increasingly dominant force in shipbuilding over the course of the next decade. And we do expect Chinese yards to take an increasingly large share of all of the contracts placed. Overall, we're forecasting an increase from a 40% share of new build contracting in 2019 by Chinese yards to an average of around about 50% of all the contracts placed per annum by 2030. In terms of the other major shipbuilding centres, South Korea's share of contracting in 2030 will be around about 25%. Japanese yards will account for 15%, and the balance will be taken up by yards in Europe and elsewhere. In terms of individual ship types, dry bulk carriers will remain the bedrock of China's new build success moving forward. However, we fully expect them to gradually increase their share across other ship types. I mean, we're seeing them already increase their share substantially in the tanker, in the container ship markets. Chinese yards performed particularly well in the latter over the last year or so. And moreover, we do expect Chinese yards to increasingly target specialized tonnage, most prominently, gas carriers, LNG carriers. Very quickly, one of the other trends is just relating to shipyard capacity. Now, as we all know, the last 10 years have been one of retrenchment for the shipbuilding industry. As I previously mentioned, global shipyard capacity fell from a peak of around about 110 million gross tons in 2011 to 70 million gross tons last year. Looking forward, we do expect this process of retrenchment to continue over the next 18 months, and we will reach this nadir of around about 59, 60 million gross tons in 2020. It'll then remain flat, but then it will start to increase, albeit those increases will be modest initially. Now, the increased replacement demand across the bulk shipping sectors will fuel this rise in capacity towards the middle of the next decade. And by 2035, global shipbuilding capacity will total around about 90 million gross tons. I know I've spoken very briefly on new building price development, but just to dig into that a little bit deeper, overall, we expect that global shipbuilding prices will increase through to the middle of this decade, albeit with a slight correction in 2023. They will then fall over the course of the second half of the 2020s. However, and this is crucial, we expect them to remain at historically robust levels, even when we're approaching this nadir that we see on this graph in 2029. They're still considerably higher than what we've seen, over the last 5 years. Now, here at MSI, we use a benchmark dollar per CGT price to illustrate new build price developments. And, to help you contextualize what the developments in this dollar per CGT price means for different ship types, the graph on the right-hand side translates these developments in this benchmark price into average new building prices over 5-year periods for different benchmark ship types and sizes. And here what you'll notice is that, as I said, our forecast new building prices across the forecast horizon remain above those recorded in the second half of the last decade. Now, moving on to alternative fuels. Prior to the pandemic, the headline challenge facing the shipping industry was this push towards a greener future. It wasn't necessarily didn't receive the press that it does now, but it was definitely coming up in the popular consciousness. Now, this, as we all know, has largely been driven by environmental policy measures at various levels, but most noticeably by the IMO. Now, prior to 2020, the initial focus in 2017, 2018, 2019 was obviously the implementation of that global sulfur cap on marine fuels that took place at the start of last year. However, with the successful implementation of that, there's been a growing awareness of their longer term goals. Now, I'm sure everybody here is aware of it, but just to recap, these are the IMO greenhouse gas emission goals. So the key agreed target of the IMO strategy is to reduce annual GHG emissions, greenhouse gas emissions, from the shipping industry by at least 50% by 2050 compared to 2008 levels. And there are also further targets on carbon intensity, specifically a reduction in CO2 emissions per transport work by at least 40% by the end of this decade, by 2030, with efforts towards 70% by 2050. Now, this push towards decarbonisation poses a host of challenges for stakeholders across the shipping industry. The crux of the issue, particularly for ship owners, is given the uncertainty around compliance at present, how do we work towards the IMO's emission reduction goals while remaining economically competitive? Now, given the current state of technology, there is no magic bullet solution. It's very, very much going to require a multifaceted approach. The infographic on this page just outlines some of the options that are currently available to ship owners on this road to decarbonisation. They're very varied. They include the adoption of energy efficiency technology and storage systems, as well as the streamlining, the optimization of operational pathways. However, it's likely that the cornerstone of any successful approach is going to lie in the large-scale development and deployment of alternative fuels. So on this slide, we give you the current status, at least to our mind, of the major alternative fuels that are currently under discussion. We've used a traffic light system. Green means well developed, red means not very well developed, and amber is somewhere in between. I won't delve into the specifics of each of the individual fuels, but what I would say is that at a very high level, we believe that the future of any of these alternative fuels lie in two key developments. So the first is a propulsion system that offers some form of future-proofing in the form of enhanced capability for retrofit, or at best an engine that is ready for a future fuel. Second, the longer-term success of any specific alternative fuel is going to lie in the feasibility of its green production at scale. Whether that's, for example, carbon capture for synthetic fuels, or using renewables to generate ammonia or hydrogen. And interestingly, the impetus for this may come from the wider economy, and as such, what we could very well see is shipping following rather than taking the lead. Now, while the uptake of alternative fuels has admittedly been very slow on an industry-wide basis to date, there has been a notable uptick in investment in these technologies in recent years. The volume of new building, so total volume of new building contracting capable of utilizing some form of alternative fuel as a proportion of overall new building contracting has risen markedly over the last 5 years. So in 2016, around about 9% of all new building tonnage ordered, was scheduled to be delivered equipped with a propulsion system capable of utilizing alternative fuels. This figure has increased to around about 1/3 since the start of 2019. So as I said, there's been this notable uptick. Now, the uptake of non-oil alternative as a bunker fuel is underpinned by several key factors, specifically scalability, affordability, environmental performance. Now, in light of this, it shouldn't really come as a surprise that at present, the majority of alternative fuels that are currently used throughout shipping are also cargoes. What this does is it really just allows the requisite technology relating to its use as a bunker fuel to evolve organically before its wider adoption across different ship types. Now, in terms of development, The most advanced alternative fuel is obviously LNG. Within the LNG carrier market, LNG fuel capable engines are now very much the industry standard, dual fuel, tri-fuel. Outside of LNG carriers, some ship types have proved more receptive to LNG as a fuel than others. Most notably here, we're talking about container ships, tankers, bulkers, ro-ro markets. The cruise ship market has also been remarkably open to adopting LNG as a fuel, but I mean, obviously, given the current situation with the pandemic, ordering for cruise ships has dried up, with the exception of 2 small LNG fuel cruise ships that were ordered in Q1 this year. However, as the graph on the right hand side shows, contracting for LNG fuel capable ships hasn't, particularly for container ships. Now, despite the popularity of LNG at present, problems with it remain that really do affect its viability as a long-term solution. The first is its emissions reduction potential. So compared to conventional fuel oils, LNG only reduces CO2 emissions, as it's currently produced, from oil-based sources. So LNG only reduces CO2 emissions by approximately 25%. The second problem is this potential for methane slip during the production, the transportation of LNG, as well as during its combustion in the engine. And I mean, what we've seen over the last 3 or 4 months is opposition to its long-term use steadily mounting. And while we don't necessarily agree with some of its harshest critics, we believe that while LNG definitely has its place in the future fuel mix, but that place is as an integral bridging fuel in the industry's attempt to meet these interim 2030 emission reduction targets. But beyond that, towards 2050, we do really start to question its viability. Caveated as it's currently produced from traditional fossil fuels. Now, moving beyond LNG, a range of other fuels are increasingly being seen as potential alternatives. The reduction potentials of each vary significantly, and that depends obviously on primary energy source, fuel processing, engine type, wider supply chain. The most consistently used alternative fuel outside of LNG, as this graph ably demonstrates, is LPG. There has definitely been a substantial uptick in the ordering of vessels equipped with dual fuel LPG engines since the end of 2018. However, again, it's important to remember that this is cargo as fuel, and all of these new build contracts are for dedicated LPG carriers, mainly in the larger size ranges, but some starting to come through in the smaller size ranges for the LPG carriers. Similarly, there has been, a notable amount of ordering for ethane-fueled ethane carriers and for methanol-fueled methanol carriers. There's also a couple of proof of concept hydrogen vessels that are being built. But outside this, and as well as, batteries and biofuels, which aren't on this graph, we're yet to see any ordering for other alternative fuels, specifically ammonia at present. So that's where we are today. What about where we need to be in terms of emission reductions and possible pathway forwards? Now, a lot has been written on this topic, and there are lots of webinars out there that focus solely on this topic. But very, very quickly, in recent years, MSI has been very active in terms of looking at how the industry can realistically achieve, these ambitious goals that have been laid out by the IMO. And what we've done is we've worked with a number of industry bodies to attempt to quantify what needs to happen for this proposed transition to successfully materialize. Now, the chart on this page provides a high-level overarching trajectory through to 2050 for the required reduction in the oil-based component of the fleet's bunker fuel consumption to meet IMO targets. In this scenario, coming on from what I said earlier, liquefied gas acts as this transitionary fuel, and its use peaks in the 2030s and then remains relatively constant after that. The overall share of carbon-free fuels remains relatively modest through to the start of the 2030s. However, thereafter, their use accelerates significantly, and by 2050, they account for 45% of marine fuels. Liquefied gas account for 20%, and the remainder, which is around about 35%, are traditional oil-based fuels. Now, of course, a lot of what we're doing at present is very much guesswork. And what I just showed you on the previous slide is one of many potential scenarios. We are very much at the start of this decarbonisation process, and it's very much a case of evolution rather than revolution. However, having said that, the situation is evolving very, very quickly. And as I'm sure most of you are aware, MEPC 76 is starting today. A key part of the meeting will revolve around the roadmap to reduce shipping's carbon intensity. So crucially, this will involve clarification on two key measures currently under consideration, the technical energy efficiency existing ship index and the operational carbon intensity indicator. And I'm sure this is something that everybody, on this webinar is going to be watching very, very closely. Now, moving forwards, the developments, at MEP 76 and everything that happens after that is really going to inform our future forecasts. So our forecasts will evolve. And if you want to discuss these developments further, or you want to dive into the complexities of our forecasts for the shipbuilding, or indeed any of the shipping and offshore markets, we would be very happy to do so. My contact details were at the start of this presentation. Simon gave you the group email address. Please feel free to reach out. We have a range of market intelligence services, from market reports to econometric forecast systems that provide very useful in navigating the uncertainties that lie ahead. In fact, we are publishing our latest reports, our Q2 2021 reports, on the various shipping, offshore, shipbuilding markets this week, and they all have our latest up-to-date thinking. So with that, albeit very brief sales pitch, I will draw my presentation to a close. Many thanks for your attention.
Thank you very much, Dave. You've packed a lot of analysis in there. So thanks. I think our audience, trust our audience will find that really useful and helpful. Now it's time for some questions, as always. And so we've had the first question that's been sent over is, sentiment in the shipbuilding market is very positive at the moment. However, according to your forecast, there will be a sharp correction on contracting levels next year. Could you provide a little bit more colour around your rationale for this?
Yeah, absolutely. As I said earlier, the positive sentiment in new building contract at the moment is driven in large part by this interest in new build contracts for container ships. So just to quantify it in terms of numbers, as I said, I think about 37 million gross tons of fresh contracting in the first 5 months of this year. Container ships have accounted for just shy of 18 million gross tons of that. And essentially what's happening is container lines are placing orders now while they have the cash and the positive market backdrop to do so, and also in the expectation that the new building prices will continue to rise, and that holds true in our forecasts as well. Now, it's difficult to see how this contracting container ships can be sustained moving forwards for 1 or 2 years. In the space of 6 months, the container ship order book has gone from an all-time low to, I think it's around about 20% of the fleet, 18 to 20% of the fleet in terms of TEU. And obviously that's going to influence how liners assess their risks to freight market balances for additional orders, and the same can be said for non-operating owners and the charter market. Now, so obviously we expect the container ship ordering boom to taper off, and on top of this, it's very difficult to see any of the other volume sectors enjoying a similar renaissance in new building ordering. I mean, as I said previously, the tanker freight markets are very challenged. Bulker earnings, yes, they're enjoying a buoyant freight rate environment at the moment, but they seem to be more interested in second-hand tonnage over new building orders. So, I mean, if you take all of these factors and combine them, it's very difficult to come to any conclusion other than the fact that the contracting levels will fall next year. But one quick thing, sorry, I know I have a tendency to talk, but I think it is, again, just worth emphasising that while we do expect contracting levels to fall year on year in 2020, they're going to then recover. And going forward, new building demand is going to be substantially higher than it has been over the last 5 or 6 years. Again, I won't go over it too much, but there's a number of factors feeding into this, some modest trade growth, but, also replacement demand, from an aging fleet, but then also this push towards decarbonisation and how that's going to impact the economic viability of some of the younger vessels in the fleet, particularly in light of, the upcoming EEXI and CII requirements that I spoke about briefly there. I mean, there's also one thing I didn't mention actually was carbon taxes. Didn't touch on those on this presentation at all. So I think all of these factors combined are going to push scrapping levels up. This is going to translate into higher contracting levels over a sustained period of time. So yes, we do expect this year-on-year decline next year, but overall, we do have a very optimistic outlook for contracting over, this forecast horizon for the next 10 to 15 years.
Thank you, Dave. Okay, another question. Hopefully that answers the first question. But another question that's come in from a member of the audience is, despite the recovery in new build contracting you're forecasting over the next 5 years, your forecast for global shipyard capacity does not increase at a similar rate, and in fact remains relatively flat through to the end of this decade. Why is that?
That's a very good question. Obviously, you can tell I like to talk, and I think to give you a sort of full answer to that question, a comprehensive answer, it would take some time, but I'll try and keep my answer brief. I know I've run over time already. So I think that there's probably, there's two trends that have dominated new building contracting this year. First, you've got this frenzy for the large container ships. Second, you have this focus on environmentally friendly tonnage. Now, yes, we have seen this uptake and we have seen this increased interest in alternative fuel tonnage, but this interest has actually favoured a select number of yards. South Korean shipyards in particular have outperformed this year. And in China, it's actually the large yards that have really benefited. So, not all yards are equally benefiting from the current surge in ordering. And what we expect is, if anything, this sort of, bifurcation is really going to help accelerate and consolidate the process of shipyard rationalization that we've seen over the last decade. As I said earlier, we're projecting that capacity will fall to, 58 million gross tons in 2020. And that compares to, 70 million gross tons in 2020. 58 million gross tons in 2022 compared to 70 million gross tons in 2020. So I apologize for that. And much of this is going to be accounted for by the closure of smaller yards in China. But, we're also likely to see further consolidation reductions in Japan as restructuring there continues, while many, small to medium yards also face an order shortfall from next year.
Thank you, Dave, once more. Now, that's unfortunately all we've got time for. Please do remember that you can get a copy of the slide deck of the document that Dave has used today, and the recording is available of today's webinar from the MSI Horizon site. If you're not an MSI client already, then please do reach out to us if you want to know more. If you like more information about MSI's products, which Dave touched on earlier, and if you just want to have a trial to one of our products, reports, or tools, we'll be very pleased to hear from you. And the email address to reach out to us is sales@msiltd.com. Please do watch out for future MSI webinars. There'll be more to come. And well, from myself and Dave now, thank you very much for joining us, and have a great day. Thank you. Bye-bye.
Bye.